You know, this is a simple question, but I think we get it all the time. And really that question is, whenever we meet with someone, what would you guys say that the number one mistake that they're making as they move closer and into retirement is? Dustin, could you start us off with that?
Yeah, we see this over and over and over again. And individuals going into retirement, I mean, the short answer is going into retirement with too much risk. Yeah. But what happens the definition of insanity is doing the same thing and expecting a different result. Financial insanity is something we see on a daily basis, is they're using the same investments year after year after year, and they're expecting in retirement they're going to get a different result.
Yeah, individuals make, maybe some, changes on the edges, but they basically go into retirement carrying the same amount of risk that they had in their portfolio 15 or 20 or 30 years ago. And one of the things I mention all the time, when you're in your 20s, certainly into your 30s or your 40s, you don't want to lose money in the market, but if you do lose money when the stock market goes down in value, it's really not that big of a deal, right? You got plenty of time to recover from that. Right. Now you move into your 50s and your 60s and beyond, if you're soon or already retired, you don't have the luxury of time to make up for large market drops. So I think that's definitely the number one mistake we see is individuals carry just far too much risk in their portfolio. They treat retirement the same as they treated their working life when they were trying to accumulate the nest egg. And they go into retirement with too much risk and really no plan on how to distribute that income and make sure that it's going to be there to last as long as they need it to.
And on that point, I find that a lot of times people may even need to switch advisors. They're working with someone that's helped them get to retirement. They're using a certain set of tools, but now that the priorities have shifted, it's no longer about growing it.
That's a great point, Dustin, because what we see more often than not is individuals transition from working into retirement, and the only thing that their advisor changes is just now they're going to start taking a monthly income out, and they'll set that up on an electronic funds transfer, and that's the plan.
Yeah.
And the investments are the same as they were 5 years ago, 10 years ago, 15 years ago. They're basically using exactly the same strategy, and they've done nothing to reduce the risk. And it's not a matter of if, but when the stock market goes through another correction, and then the income's not going to be there for them.
Or we'll get the classic, we switch from 60-40 to 70-30, the bond to equities. And that just doesn't work. That's maybe 25 years ago that may have worked. But things have changed.
Jordan, what individuals really need to do that find themselves in that scenario is getting closer into retirement is they have to work with somebody that's going to show them ways to dramatically reduce the risk typically in their portfolio. So when the next stock market correction comes along, they can handle it, they can weather it just fine, the income's still going to be there.
There has to be that paradigm shift.
Correct.
Absolutely.
Yep.
Yeah, the next question that we have really is, whenever you're working with an advisor, what's the most important thing to look for when choosing one?
Well, I would have to say probably the most important thing, there's a lot of things, but the most important thing I would think would be work with somebody that's independent, would be the first thing I would look for. And usually your independent advisors are also going to be fiduciaries. Registered investment advisors is the technical term for that. But someone that's independent. I started my career at one of the large firms that are out there. And what I found was as I moved up and had some success and moved up into management, the higher up you get, they kind of sit you down in the corner and they say, okay, now we're going to let you in, we're going to tell you how things really work around here. And what you find out is a lot of the things that we were told to recommend to our clients weren't necessarily what was best for our clients, but it was really best for the firm that we were working for, the regional manager or whoever it was that I was reporting to at the time. So that's why I left that large firm and started Strategic Wealth Designers, because I wanted to be independent. I didn't want to have quotas. I didn't want to have someone questioning my recommendations and why didn't I recommend this when we make more money selling that. I wanted to truly be independent and not be tied to just one company and their options. I wanted to be able to work with all the different companies that were out there and be able to work with all the options. Now, obviously, I'm sure you could follow up on it. There's more than just finding someone that's independent. Honesty, integrity, you want to make sure they've been successful, things like that. But I think it all starts with working with somebody that's an independent advisor.
And Dustin, could you touch a little bit, I know you mentioned it, Matt, on the fiduciary. What really does a fiduciary mean for those who might not know it very well?
Yeah, most people don't know this, really is what we find. There's two different types of advice that you're going to go get. Anytime you go get financial advice, they're following one of two standards. One is the fiduciary that Matt just mentioned. What that means is that the fiduciary has to recommend only what is in their client's best interest. So what that means is they really have to learn the ins and the outs and what are the goals and what are the priorities. What are they trying to accomplish in retirement so that they can recommend and use tools that are actually going to get them there.
Well, and to add to that, I mean, and they have to know about every available tool that's out there. they can't just be a specialist only at stocks or only at mutual funds or only at annuities. They have to know about every available option for the client because every client situation is a little different.
That's right. That's right. Where the opposite of that would be a registered representative, and that's typically what you'll see at a lot of the big brokerage houses or the big firms that are out there. They use a lot of registered representatives, and what happens then is their fiduciary responsibility is not to the client; it's actually to the firm that they work for. So when they recommend something, it may not be in their client's best interest. Yeah. It may not help them get to their goals exactly the best, but it's what's their boss told them to recommend.
It's what they have to do in some cases, right? Because the atmosphere I came out of, we had quotas and things like that. Yeah. And they kind of tried to force us into recommending things for our clients that weren't necessarily best for our clients, but it's what helped us hit the quarterly earnings report we were trying to hit, or the regional manager was trying to get their bonus or trying to move to the corner office, things like that. So a lot of times the advisors may be good people at those places, but their hands are tied.
That's right.
And they're forced to do things that might not necessarily be best for their clients.
Yeah.
So probably the two most important things to do would be independent, of course, but also be a fiduciary, but a fiduciary for your clients.
That's correct.
Yeah. So if you all have any more questions for us, just feel free to give us a call or check us out on the website.
So what ends up happening over time is you get to take advantage of the volatility in the market, meaning you don't like it when the stock market goes down. Nobody likes to see that, but if you're actively contributing to the account, you're actually getting to take advantage of that a little bit. Let me explain the differences between active and dormant accounts. Basically what we're talking about here is this. If you have an account that you put money into on a monthly basis, maybe through your current employer or any other type of investment program, if you're putting money into it on a monthly basis, that's considered an active account because obviously you're actively contributing to it each and every month. Now the opposite of that would be a dormant account. And a dormant account is any account that you have that you do not put money into at least on a monthly basis. That's the key. So it could be a previous employer's retirement plan that you never rolled over, or maybe you did roll it over, but you're no longer contributing to it. Those types of accounts are considered dormant. And what ends up happening more often than not is I see that advisors will basically treat active accounts and dormant accounts exactly the same, when in reality you really shouldn't. You should have a different strategy for an account that you're adding money to on a monthly basis versus an account that you're not adding any money to. And let me go over an example as to why. So if we take a look at the stock market over time, if we basically simplify it a little bit, we know that the market goes up and goes down. So if you're actively contributing, if you're putting money into that account each and every year, what you do is you get to basically take advantage of what's called dollar cost averaging. And that means that you're putting money into the market or into possibly the mutual fund if you have a 401k or a 403b, something of that nature. You're putting money into it when the market's low, and then you're buying it when it's a little bit higher, and then you're maybe buying a little bit here, but that's okay because then as the market goes back down again, you're still putting money in when it's low. So what ends up happening over time is you get to take advantage of the volatility in the market, meaning you don't like it when the stock market goes down. Nobody likes to see that, but if you're actively contributing to the account, you're actually getting to take advantage of that a little bit because you're taking advantage of the volatility, meaning you're buying more shares at a lower price when the market went down, and that will actually help you recover more quickly then when the market goes up. So in an actively funded account, again, maybe a 401k, 403b, any other type of investment program where you're putting money in monthly, having this type of volatility can be okay. And where we see this more often than not, obviously, is going to be with mutual funds. Most 401k plans, 403b plans will be strictly invested in mutual funds, and that can be an okay time to use mutual funds. It's not necessarily bad because you're able to take advantage of the volatility. However, whenever you have the opportunity to roll those types of dollars, either in a 403b or a 401k, over to an IRA, we usually recommend that you take that opportunity. And the reason why is because once we move into an IRA, typically it's going to become a dormant account, meaning you're no longer putting any money into it. And the IRA is going to have some advantages. You basically have more options than what you used to have when you had the money in your employer's plan. So mutual funds are still an option if you want to contribute monthly to the IRA, more often than not, you're no longer going to put any additional contributions in the IRA. So now you have other things that you can invest in, maybe exchange-traded funds or annuities, or maybe individual stocks or bonds, real estate investment trusts, really almost anything that you can think of. You have more options. And what you can do with an IRA, since you're no longer contributing to it, is you can add safety nets to that money. Meaning when we have a situation where the stock market starts to go down, again, you're not taking advantage of that volatility. So what you want to do then is protect the principal. You want to protect and preserve the principal that you have built up in the account. Because again, unlike when you were actively contributing, there's no advantage to you when the market loses value. If you're fully invested, you're not able to take advantage of it. So what you want to have is safety nets. One of the things we do at our firm is we use something that's called a stop loss. Not with every position or every investment that we use, but a stop loss is basically something that when things surprise us in the market or in the economy and the market starts to react and go down, well, basically that position can be sold and just moved to cash. And in particular, when it's inside of an IRA, that's possibly a good strategy to follow because there's no tax consequences of doing that. Obviously, the IRA is just growing tax deferred. So if the position is sold, you don't have to worry about paying any additional taxes. So it's a strategy that works really nicely, and it's something that we definitely recommend individuals that are definitely within about 10 years of retirement going ahead and taking advantage of the options that you might have that would be a little better inside of an IRA than, say, just a regular mutual fund. So again, when you have an active account, it's okay to use mutual funds. Once the account becomes dormant, you usually want to avoid things like mutual funds where you're just left to the mercy of the market, and you want to have some sort of an investment that is going to have a built-in safety feature, or if not, then again, work with a firm like ourselves where we could possibly use a stop loss on it. Because what ends up happening is if you have a dormant account invested directly in the stock market, maybe with mutual funds, what will happen is as the market's volatile, you're not using that volatility to your advantage, and the fees and expenses that you have to pay end up kind of acting like an anchor over time. So this is an issue that's misunderstood by a lot of individuals. Even a lot of financial advisors don't necessarily understand the differences between active and dormant accounts. So this is why my book on retirement planning, I spent an entire chapter covering this specific example in detail.
So if you're basing your retirement income strategy or plan on dividend income, I think it's important to at least get your arms around exactly how much risk is actually there. I want to talk a little bit today about dividend income. A lot of times people think that dividends are relatively safe, and they can be a great part of your portfolio, but I wouldn't base your whole income plan off of dividend producing positions. I've got, for an example here, Bank of America. And back in 2007, a lot of people were holding Bank of America stocks in their portfolio. And I've got the numbers here. I'm going to be looking back and forth just to make sure that I gave you the right number. And I've got an example of a gentleman that was receiving $28,992 a year off of a $500,000 portfolio in dividend income. This is 64 cents a share is what he was receiving, and his share price was $44.17. So this equates to a 5.8% dividend. Very nice dividend paying position. I would use that right now if it were available. Now, let's fast forward. So that was back in September of 2007. Let's fast forward a year and a half later. So now we've went through the 2008 correction, and we're in March of 2009. So now his $500,000 portfolio is worth $43,148. So the share price has went down from $44.17 to now it's at $3.81 a share. He's receiving a 1% dividend, 1.05% dividend, which is 1 cent per share. He's receiving $453 per year in dividend income. So remember, back in 2007, it was $28,992. That number has fallen now to $453 a year. Let's fast forward to today, because I'm sure a lot of you are thinking, well, that was back in 2007 or 2008. Now everything's back to normal. Well, you're right in thinking that after a correction, it usually takes about 7 years just to get back to even. However, this particular position, if we look at it, depending on the day you look at it, right now it's $15.70 per share. It's paying a 5-cent dividend, which means your total portfolio value would be $177,803 now. So remember, back in 2007, we were at $500,000. Now it's worth $177,803. That's producing $2,265 per year in income. So basically 10% of where it was back in 07. So if you're basing your retirement income strategy or plan on dividend income, I think it's important to at least get your arms around exactly how much risk is actually there. So I think a lot of people are just on autopilot or on cruise control, and they're not really thinking about that type of scenario happening again. But I would make sure that your portfolio is completely protected, or as much as possible, so that if something like this were to happen again, it doesn't affect your lifestyle. If you have any questions about how much risk you actually have in your portfolio, and just to make sure that it matches up with how much risk you're comfortable with, please feel free to call our office and/or visit our website.
Now, a lot of times there's a misconception that in order to maintain safety, we have to give up liquidity, and vice versa. This misconception comes from the idea that there is a time commitment string attached that provides increased safety to investments. This week's segment of Strategic Wealth University covers an issue that comes up in our office often, and that is, how does an individual pair liquidity with safety? In order to answer these questions, we need to see the difference and talk about what both ideas mean in the investing world. Liquidity in the investing world can be defined as the ability to readily access funds. An example of something with complete liquidity would be a savings or money market account, or something that we can readily get our capital from. Something on the opposite side of liquidity would be a piece of investment property, or something that we cannot readily access, perhaps some annuities or CDs also. Now, safety can be defined as protecting ourselves from complete market failure. That is, when a stock market correction happens, like in 2008, we don't have to worry about losing anything. Now, a lot of times there's a misconception that in order to maintain safety, we have to give up liquidity, and vice versa. This misconception comes from the idea that there is a time commitment string attached that provides increased safety to investments, but because of that time commitment, we lose liquidity and cannot access our funds for a certain number of years. The question is, how do we maintain liquidity, having our funds readily available for withdrawal, but also maintain safety, protecting our hard-earned assets from loss? An effective way of doing this is through the use of a stop loss. For those that are unfamiliar with the stop loss, it is a way to help protect an individual's portfolio from a downside correction in the market. For example, John has $100,000 of blue chip stock. He wants to keep these funds safe, but for him, more importantly, he also wants to keep them liquid so that he has access to them because he doesn't want to tie his funds up. By placing a stop loss on the account, when the market begins to go through a correction or the price per share goes down to a certain point, let's say 10%, he can automatically sell out and is not subjected to the heartbreak that individuals went through in 2008. So as another example, let's say company A is trading at $100 per share. We place a stop loss on company A that is 10%. That means that if company A goes down 10% or $10 per share, we sell out automatically at that price of $90. Now, there are also additional variations to the traditional stop loss. There are trailing stop losses, which trail the growth of the investment. So as the market grows, we can incrementally inch up our stop loss to participate in more of the gains of the investment. Now, a stop loss is only available to an openly traded investment, meaning that if funds or investments are bought and sold throughout the trading day. Now, in this instance, we could put a stop loss on an individual stock or an ETF. Now, an ETF is a basket of stocks or bonds that trades openly throughout the market day that tracks a large area or sector of the market. Now, a lot of people will come into the office and they'll say, Jordan, can you put some stop losses on my mutual funds? And unfortunately, I have to tell them that mutual funds do not have the ability to use a stop loss. Now, the reason why As a mutual fund trades, it trades at the end of the market day. Now, our execution or the action of the stop loss would occur at the end of the day. Now, you wouldn't capture the goal of a stop loss because, of course, a lot can happen during the course of an investment day, especially in a volatile up and down market. Now, stop losses can be a great portfolio enhancer and can minimize downside losses. For those seeking a reasonable rate of return in the stock market, but also want to protect themselves from a downside loss, a stop loss more times than not could be the appropriate solution. As a firm, our brokerage team uses stop losses to protect our downside, and we fully believe that it is the best way of pairing liquidity with safety. If you would like more information on a stop loss and ultimately how they function, please give our office a call or feel free to check us out on the website.